Good morning. Direct from a JP Morgan analyst, DOGE Layoffs signals the end of our rolling recession. So, for the past 3 years of the US economy, it's felt like we've been in a recession, even though the GDP numbers didn't quite confirm it. Michael Wilson, chief US equity strategist at Morgan Stanley, says the feeling was real, calling it a rolling recession. According to his latest note, the worst may now be behind us, with Elon Musk's Department of Government Efficiency, or DOGE layoffs, marking the true turning point. So, what is a rolling recession? Unlike traditional recession, where the entire economy contracts at once, a rolling recession moves through multiple sectors over time. Since 2022, industries like tech, housing, retail, and energy all hit their downturns at different moments. In the final domino, the government sector, where DOGE driven layoff cuts over 280,000 jobs earlier this year. Wilson argues that this was the bottom. He cites April 2025, the Liberation's Day stock market lows, as the trough that ended the rolling downturn. So, from recession to recovery, the good news: with every recession comes recovery. Wilson forecasts a rolling recovery with small cap stocks, corporate earnings, and investor confidence rebounding into 2026. His bull case even projects the S&P 500 climbing to 7,200 by mid-26. For commercial real estate investors, this matters. Historically, CRE demands trail stock market recoveries, and as corporate earnings rise, businesses expand, and they need office, retail, industrial, and flex space. Investors who position early catch the upswing. So, the labor data, past pain and a brighter future. Job cuts peaked in March 2025, with payroll data revised downward by 911,000 jobs, one of the sharpest 2 month adjustments in U.S. history. While the pain was real, Wilson says the worst is over. Earnings and growth in small and mid cap companies has turned positive for the first time in years, a classic early cycle recovery signal. For CRE, stronger earnings means tenants are healthier, lease renewals stabilize, and cap rate compression can return. So, the Fed, the fiscal policy, and its CRE implications. Markets expect aggressive Fed rate cuts ahead. If the government labor market weakens again, those cuts may come even faster. For CRE investors, this is critical. Lower rates reduce financing costs. That's the winner right there. Developers can restart shelves projects, which there have been a lot of them. Asset values can rise as cap rates compress. And meanwhile, the Trump administration run hot strategy may fuel growth, but also carries inflation risks. If inflation accelerates, CRE investors should hedge with assets in growth quarters like Katy, Fulshire, and Houston's industrial markets. So the takeaway is for CRE investors and business owners. The DOGE layoffs may go down as the symbolic end of a rolling recession that began in 22. And if Wilson is right, the next phase is a rolling recovery. And early movers in commercial real estate, financing, acquisitions, and development can catch for the upside. So here's the pro tip. Now is the time to refinance at lower rates, lock in long-term debt, and explore expansion opportunities while others remain cautious. Let's go. Have a good day.